Okay, well, we're going to go ahead and get started. Thank you again for being here on a kind of rainy first day of fall, right? This is the autumnal equinox, pretty auspicious day. My name is Mike Lyons. I am a SCORE mentor and workshop facilitator, and I have the pleasure of going through this presentation with you, where we're going to talk about understanding financial reports and systems. But before we do that, there are a couple of things I'd like to do. One, we've got a couple of folks here at the facility in Thornton. If I could ask you all to just kind of introduce yourself, your first name, and maybe where you're from. And then if we can do the same thing online, that would be great. So Jeremy, why don't we start with you?
Yeah, I'm Jeremy. Currently own a graphics company here in Denver. And I've actually been working with Mike a little bit, so kind of new to the workshops, but looking forward to it.
Yeah, thanks.
My name is Rachel, and I own 2 short-term rentals and a camper van rental business in Denver as well. Originally from Georgia, but looking forward to getting more organized with my numbers and financials.
Excellent. Oh, that's great, Rachel. Good to have you here.
Yeah.
Then how about online? Anybody want to take the first step, unmute yourself and introduce yourself?
Hello, can everyone hear me okay?
Yes, yes.
Yes, my name is Laura, and we currently own a small construction company. My husband and I just started last July, so I'm excited to learn a little bit more about our company. And yeah, I'm excited to see or to get to know all of you guys.
Thanks, Laura.
Hi, my name is Chance Dingman, and I'm in Arvada, Colorado, and I'm in the process of starting up a ATM business, and then end of the year Airbnb rental. So kind of just getting my feet wet in the financial reporting space.
Very good. Great. Glad to have you this evening.
Thanks.
Hi, my name is Durella Montoya, and I own Bella Star Aesthetics in Thornton.
Huh, very good. Anybody else? Okay, well, I think we'll go ahead and get started. I appreciate everybody's brief introduction. A couple of other things about the class before we get started. If you wouldn't mind, if you're online, muting your microphone, unless you have something to say or a question to ask, that'll be really helpful. That also gives you a chance to eat dinner while we're going through this. Another thing that's worthwhile mentioning here is that this workshop actually is part of something that SCORE, the Denver chapter of SCORE, provides on a monthly basis online. So the original author of this, you'll see him referenced at the bottom of the screens now and then. His name is Tom Moore. And Tom provides these workshops about once a month. In the event you didn't get what you need out of this one, Tom's workshop probably would help you also. And then SCORE also provides online an on-demand version of this. So you can effectively go to SCORE's website at score.org and find these workshops on demand also. As the title kind of implies, this is the first of 2 parts. So today we're going to go through some context around reporting and setting up businesses and running businesses. And then next week, we're going to talk about some of the things that happen to entrepreneurs as they manage their finances. That's probably the best way I can describe it. We'll talk about how to read reports, how to look for problems in reports, and what to do when you find problems. So that will be a part of what we talk about next week. For those of you that are online and in person here, we have a number of handouts that will be provided, including this PowerPoint presentation will be provided to you online or through email after this session. So hopefully that'll work for you. For next week, we'll also provide quite a few handouts that will, I think, be helpful to you as we go through that workshop next week. So we'll get started. Yeah. If this looks somewhat familiar to you as a business owner, just recognize that this is kind of the way the life of an entrepreneur or a business owner works, right? You have a bunch of plates that are action items, deliverables, schedules, customers, relationships, vendors. All those things are really kind of like spinning plates. And as you work day to day, your job is to keep those plates from crashing and burning on the ground. It's a tough job, and there's a lot going on. One of the things that you're going to find, I believe, as you continue with your business or start your business, is that it becomes more difficult to maintain those plates and keep those plates spinning by yourself. So one of your jobs is going to be, as you think about learning and understanding your business, where and how do I shift those plates to somebody else? Because ultimately, you're going to want to have your time available to evaluate your business, do planning, reflect on what's going well and what's not. We'll talk about that in a little bit, but you're going to want to do a lot of things that don't involve keeping these plates spinning. So my encouragement to you is, as you're building your business, think about ways that you can have people help you keep those plates from hitting the ground. And what I'd encourage you to do is not be fooled by the expression on this guy's face. His plates are going to drop. It's just a matter of time. But through looking at your business more proactively and getting help, I think you'll find it to be a much better experience than having plates hit the deck. Something to keep in mind as we go through this, we're going to be talking about a lot of information and detail. There are going to be a lot of different topics to think through and consider. My encouragement to you is take notes, ask questions either during the process of the workshop or afterwards. You'll be able to reach me via email primarily, but also to recognize that if you have preconceived notions about how businesses should work, my encouragement to you is to set those aside. Things that you have learned along the way are probably going to be very helpful to you, but things that you kind of assume or things that you've heard from other people but not experienced firsthand, a lot of times that can be incorrect. So I'm encouraging you to kind of keep an empty cup mentality here. Think of this in terms of you can't put more into a cup if it's already full. And there's kind of a cute Zen story about a Zen master and one of his students that are sitting together having coffee. And the student is telling the Zen master all of the things that are going on in his life and all of the things that he's struggling with and all of the things he wants help with. And the Zen master starts to pour or fill his cup with tea, and he keeps filling it and filling it and filling it. And after a while, as you can see from the illustration, it overflows. And ultimately, it pours on the table, and the student gets kind of irate about it and asks what's going on. And the Zen teacher says, I can't put more in your cup until you empty some of this. So come forward, kind of participate here with an empty cup attitude. And I think you'll find some real value in what we're going to cover. So this next slide is pretty busy, and I want to give you a chance to kind of look at it for a minute before I talk about it. So you can kind of think of this in terms of kind of two halves of your business that are balancing on this pyramid in the center. If you see that, you can see on the left side, you've got this notion of vision. And on the right side, you've got this notion of alignment. You also can kind of divide it, between reputation and things related to people and relationships on the left, and activities and transactions and things that you might do in the business on the right-hand side. Ultimately, what we're illustrating here is on the left-hand side, where there's this notion of vision. You want to be able, as the leader or the founder or the owner of your business, you want to be able to lead that and provide direction, provide insights into where the business is going. And that's really what we're describing here with regards to vision. However, that shouldn't take a bunch of time. And as we start talking about planning things, we're going to be talking about lots of planning activities. And my inclination to you is you might think about this as, wow, this is way too much planning. I need to spend more time keeping plates off the ground. But the point that I'm trying to make here is that planning is really important. Setting that vision is really important. Staying on the left-hand side of the screen, the other thing that this is talking about when we talk about relationships and people is your reputation. Getting a reputation, keeping it, growing it. And you do that through employees, which meet customer needs, which generate shareholder value. That's really the notion there, is all of this stuff around relationships and people. On the right-hand side of the screen, we're talking more about activities and transactions. We're talking about things like productivity, how to do things better, faster, cheaper, what that means to your organization. You're going to be making products or services. You're going to sell those. You're going to do record keeping, which is what we're going to talk about today. And that is the sort of transactional part of your business. On that right-hand side, that block that mentions alignment, that's really going to be important, because alignment is so key to your ability as an owner or a business leader, or even a founder. That getting people aligned in your organization is so important. And the best way to do that is through having repeatable systems, processes, and a heart for communication, in making sure that people that are doing these transactions and these activities are well aligned, they're well coordinated, and they understand what's expected of them. In the center, that pyramid that you're looking at is what I'm going to call and refer to in the future as the planning pyramid. And we'll talk about that in a moment. In summary, on the left-hand side, these are doing the right things. These are setting the goals, setting the vision, moving in the right direction. And on the right side, it's doing the things right, how to do things. And so you can kind of think of your business in sort of those two fundamental sections or departments. Let's talk about this planning pyramid. Let's let's see, did I go too far? Nope. We'll cover another concept and then we'll jump into planning. So again, we're going to get into the financial reporting piece, but I want to give you some context around what it means and what you're going to be reporting and what you're going to try to find in your assessment of reports to help you run your business better. And this illustration comes from a great book called Good to Great by Jim Collins. And what Jim is speaking of here is what it takes to be a really good entrepreneur, a good business owner, a good leader in your business. And there, as you would kind of expect, there are three things that he speaks of that are important. The first thing at the top here is what you're deeply passionate about. And so passion here is, where your interests are, what drives you and provides you energy for your business, things that help you run your company based upon what's in your heart and in your gut. And one of the things that I think is so helpful is that with passion, you have more energy, you have sort of sustainability, you have the ability to get through the tough days. And without that passion, I think it's really, really hard to keep going. And people that don't have that passion, I often feel kind of struggle. They find their work really difficult. And a lot of times they quit. Along with being deeply passionate about your business, you have to understand what drives your economic engine. Now, this is kind of an interesting term because it's different for different businesses. In some cases, if you're a consulting company or a construction company, it may be billable hours, right? If you're a product manufacturer, it may be the products that you sell. If you're doing something else, it may be a different economic engine. But it's really important for you to understand what that economic engine is for your business so that you can protect it, so that you can grow in areas that make that economic engine flourish. It's going to be apparent to you as you start to look at your financial reports where and how that economic engine is operating. And so being able to name it, being able to kind of recognize what it is going to be key in your ability to run your business well. The last circle here is this notion of being the best you can be, or the best that your company can be in the world, particularly in the local area that you serve. What does it take to be the best among your competitors? What does it take for your client base, current and future clients, to look at you and say, I want to do business with them because they're the best. They're the gold standard when it comes to being in this business. So those are the three things that Jim Collins identifies or calls the hedgehog concept. And it's kind of an interesting story why it's called hedgehog. He does a comparison between a fox that kind of goes everywhere, that does all sorts of things to survive, versus a hedgehog that has a very specific, well-defined set of criteria for survival. And from Jim Collins' perspective, this hedgehog concept really applies well to business. I'm going to stop here and see if there are any questions or comments. Okay. So here we're going to jump into the planning pyramid. This is an important concept that also relates to financial reporting. And I say that, although it doesn't perhaps look intuitive that it is, but this provides, this notion of a planning pyramid provides you with a structure that is very, very helpful in the businesses that I've been involved in kind of helping me organize and helping me recognize what's important in my business. It gives me guardrails to work within. It gives me, as you might see here, a sense of what my core values are, which are kind of the foundation of the planning pyramid. It helps me know how to behave, how to operate, how my employees should behave and operate. It does a lot. Sort of at the next level is purpose. So what am I all about as a business? It goes back to the hedgehog concept, right? What am I best at in the world? What's my passion about, and what's that driving me? How do I affect my purpose in life? How does my company affect its purpose in life? From there, we go on to targets. Now, targets are where we start to get sort of very business oriented. These are 3 to 5 year targets. This is where we start to look at the value of planning. These are things that you're going to assume and develop with your partners or your board or people in your life that are influential in your business. These are setting the goals for you, the long-term goals for you out into the future. Without those goals, when you look at your financial reports, when you look at your balance sheet, when you look at your income statement, you're not going to have a good sense of how you're doing unless you've got a goal to achieve, a goal to pursue. So that's where these targets come into play. Next, on top of that, are actual goals. These are annual goals that are part of what you might do in an annual planning process. They're taken from the targets that you've established over 3 to 5 years. They're things that you're going to commit to during the course of the year for your business. And again, they tend to give you a good, clear understanding of what you intend to do during the course of the year. On top of the goals are actions. These are things that are typically done quarterly. These are things that you reset instead of just having a goal for a year and then coming back the following year and checking to see if you did it. The intention and the idea with the planning pyramid is that every quarter, what you're going to do is you're going to give yourself the time to look at where you are with your goals, to be able to understand where you need to change, to understand what's changed in your environment that you need to react to. And it gives you a chance to reset if you've got a management team that you're working with, if you've got employees that you're working with, even in some cases, clients that you're working with. It gives you an opportunity to reset on a quarterly basis to meet those goals. It's a really, really effective way to do that. Then you're going to be looking at reports that are going to help you understand how you're doing from a quarterly perspective or a monthly perspective. And that's where we start to see things take shape with regards to scheduling, right? How do I plan and schedule my work so that I can meet those actions or those quarterly objectives that I have? What do I need my teams to do? What do I need the people that are working with me to do? What do I need my bookkeeper to do when these scheduled activities take place? So it's an important concept with respect to how to keep people aligned. Remember, we talked about alignment a little bit, how to keep those schedules aligned based upon how you've built this up. And then last but not least, this notion of accountability. This is something that you do day in and day out. It's done with respect to who is responsible for getting things done. You know, we started with this illustration of this guy spinning these plates. In your job as the owner or founder or the leader of your organization, one of your roles is going to be making sure people keep their plate spinning. And that's the role of accountability. That's what you'll be doing is keeping people accountable for making sure those plates don't drop and hit the ground. So it's built based upon core values, purpose, targets, goals, actions, schedule, and ultimately accountability. And if you can instill that in your planning process, go back to that notion of 1% vision, right? 1% of your time should be spent doing this planning and setting up of your systems. I think you'll find it to be really, really helpful. We're not talking about big commitments of time. We're talking about doing it well. We're talking about doing it consistently and doing some other things that we'll talk about here in a minute to help keep that going and keep that process happening. So what do we do when we talk about this planning process? One of the things that I like to encourage people to do, and I know Tom does as well, is this notion of PRE, so planning, reflection, and evaluation. Again, this is part of that 1% that I'm talking about. So looking at what does it take in your business to move forward, doing the planning, setting the vision, reflecting on what's working and what's not, evaluating things that need to be done, setting plans in place. Those are all important aspects of your job as an owner. They're easy to set aside. They're easy to say, I just don't have time today for this. I've got 100 other things I've got to do. But my encouragement to you is if you schedule them, you plan them, you give yourself time for them, they'll happen and you'll find value from them. The bottom part of this slide is talking about how, as an organization grows, it becomes so much more complex, right? If you start from the left-hand side where those little people are standing, you can see, if you've just got 2 people in your organization, that notion of communication is pretty easy. It's 2 to 2. And then if you add another person, that adds a whole new dimension of complication. So that's 3 to 6, 3 people having 6 different ways to communicate. If you add a 4th person, that doubles the complexity. So it's something as a business owner you need to recognize that as you bring more people on, as you bring more partners on, as you bring more clients on, your business is going to be more complex. It's going to be harder to keep track of. It's going to be harder to stay in the details of it. It's going to be harder to do the day-to-day work that needs to be done. So what do? You bring people on board. Maybe it's internal people, maybe it's external people that you contract with, but you get help and resources to help you do that. And that becomes kind of a challenge because what takes place is you have these inconsistencies. Joe doesn't do it the same way Mary does it. So then you start to find yourself putting procedures and policies in place. And that starts to bring additional complexity. Although those policies and procedures are helpful and address this complexity issue, they also take time. So as we talk about reviewing these financial statements, which I promise we're going to get to, think about that in terms of how do I make time for myself to review these statements. And one of the ways to do that is to set repeatable processes, repeatable policies, so people understand how to work together and how to execute on your vision of the company and what you're trying to do, your core values, your purpose, those things. Comments or questions? Okay. Another kind of piece of context that I want you to keep in mind as we go through this and start to think about our financial reporting. And this is a client matrix, which kind of divides up solutions in the vertical axis and clients in the horizontal axis. So you can see, if you look at the bottom left-hand dark green box, this is where we're talking about existing clients and existing solutions. So as a provider of products or services, you're going to find that it's so much easier to sell your products or services to existing clients using existing solutions. It just makes sense, right? It's where we try to get when we put our policies and procedures in place, is to provide predictability in our products, relationships from our clients, and that really helps our business operate better. The next best way to do that is if you go up a block, right? That light green box is this notion of existing clients and new solutions. So here you're working with a current relationship, but you're bringing new products to the table. And this is usually where a lot of companies see growth, right? This is where you've got an existing relationship, you've built trust with your client, they like doing business with you, and what you're doing is you're introducing new products and new services, new solutions that they can become aware of and they can buy from you. So that's where growth starts to happen. And that's really kind of a cool area, and something that I'd like you to keep in mind as we go through these reports, because that's where you're going to start to see growth. The box on the bottom right, that yellow color, this is where you're starting to find new clients with existing solutions. And this is also where growth happens. You're selling your current products, your current services, and clients are becoming attracted to you, hopefully through a great reputation, hopefully through referrals from other clients. But this is where you're starting to also see and get leverage. When we start with existing clients and existing solutions, it's probably the easiest. And now we're starting to see where it gets harder and harder and harder. And finally, when you get to this red box at the top right-hand side, you're looking at new clients and new solutions. And this is what happens when you start a new business. This is what you're doing. And this is why so many businesses find it difficult to succeed as they get going. Because the world, the universe, the competition are all pushing you and providing a headwind to you to prevent you from succeeding. And it's really difficult when you're operating in that red box. It's really difficult to be successful. People do it all the time. I don't mean to say that they don't, but when you start with new clients and new solutions, that's a tough way to go. Comments or thoughts about that? Okay. So let's talk about, you're getting ready. You've had a couple of good months. You've gone through your visioning exercise. You've set some policies. You kind of know where your clients are. You've got maybe an employee or two. You're starting to see the business take shape and start rolling forward. And you're ready to start looking at some financial reports and doing a little bit of evaluation and planning and reflection. So in that process, some of the things you might ask yourself would be, what's going well? What am I doing that's attracting customers or clients? How am I delivering my products or services? How am I making money? What's going well in that process? Do you need to do anything more to keep it going well, right? Don't just assume that because it happened last month, it's going to happen again next month without some attention, some focus to make sure that you can consistently drive it and make it happen month after month. So is there anything else you need to do? Are there any changes in technology or the business environment that could threaten your business? This is kind of an interesting one. And a lot of times I've been guilty about this myself. You know, I'm back at the first slide where all my plates are spinning and I'm spending time, you know, trying to keep them from hitting the ground and bringing people on board to help me. And I'm not paying attention to what's going on in the industry or what's going on in the environment that I'm working in or what's going on with technology. And if you don't give yourself this evaluation and reflection time, you're going to miss some of these things. I read an interesting article just recently. Excuse me, I take a drink here. Did you know that in 2000, in the year 2000, there were 9,000 Blockbuster video stores in the nation? 9,000 of them. Blockbuster stock was killing it. They were, you know, on the top of their game. And what started happening was technology started to change. Netflix showed up on scene and they had a different business model. Ultimately, Netflix started taking their clients. Then came along, you know, the channels, the streamers, the cable guys. People started seeing that entertainment, video entertainment, was really quite an open market. And over time, what's happened is Blockbuster has effectively lost 8,999 stores. One store remains in Bend, Oregon, and it's a tourist attraction. That's a pretty sad story for somebody that was 22 years ago was killing it in business. So the moral here is self-explanatory. Know what's going on in your business. Know what's going on in the industry that you serve and understand what changes are taking place outside of you that you need to be aware of that will influence your business. If you don't know, do things like join an industry group. You know, industry or trade associations are a good way to kind of keep track of what's happening in the area, in your domain, so that you don't get blindsided by something like hurt Blockbuster. Another thing you might ask yourself as you're going through these pre sessions, right, is what isn't going well? What do you need to change? Can you fix it? And my encouragement to you is don't try to fix something unless you thoroughly understand what the problem is. And that's what these financial reports are going to do for you. They're going to help you understand where and what the problem is. Another thing that's important to recognize is not every one of your products or every one of your services, or perhaps a major part of your business, is going to make it. You may have emotional attachments to, you know, certain products or certain services. Maybe it's the first one you started with. But if it's not going well, you've got to consider what you're going to do with it. And it is, in the end, about business. So if you have to kill a product or kill a service that's not operating and working for you and generating profit for you, just recognize you may be in a position where you have to do that. But you won't know it unless you go through this planning process. Another way to deal with things that aren't working well are, you know, are there other adjunct products or services that you could sell to your existing client base? Right? We went back to that client matrix, right? What can you do with an existing product or service to sell it to an existing client or maybe to a new client? Another thing to look at is, has your organization changed? Are your skills and knowledge different? Are there other things that you could bring into your organization that might help give you an advantage over a competitor, or might help you go into another area that perhaps you hadn't considered in the past? I'm working with a landscaper, and he hired a guy to help him with landscaping, and found out this guy was a whiz at irrigation systems. He just knew irrigation systems like the back of his hand. Prior to us joining the company, they didn't do irrigation. So now he's got a new tool in his tool belt to offer. Those are the kinds of things I'm talking about. Knowing the skill sets of people that you hire, understanding where they are, what they know is really, really helpful as you build your business. Where can you leverage their skills? How can you leverage money that you've already put into marketing? How can you leverage goodwill that you might have with your existing customer base? These are all questions that, as you go through this process of sort of evaluation, this pre-process, planning, evaluation, and reflection, these are all things that will help you a great deal, along with reviewing your financial reports. So you've started the process, you kind of looked at things, and you're now in this place where, what do I need to do? So here are some of the things that Tom has suggested that will help. Exceed customer expectation philosophies. Provide good, best-in-class ways to complete sales. Make sure that as you're competing with your competition, with other businesses in your space, that you're doing the best job possible to ensure that your client's experience is great, as opposed to what they may experience with other organizations or other companies. Provide timely follow-up, right? Identify and develop replicable processes. So this is going back to something I mentioned earlier, this notion of, how do I keep people aligned? How do I make sure things are working properly? You do that through this notion of good processes, replicable processes that people can learn, they can follow. Those are big parts of what's going to be important for your success in business. Apply these processes to all aspects of your business. If there's something that you do over and over again, turn it into a process. And I'm not talking about processes that you have to write out and that you have to bind in a binder and put on a shelf. These can be informal processes, but know how to get them done, know who's supposed to do them, know who's accountable for the process's results, and make sure that people understand what's expected of them when you do put these processes in place. This will result in fewer daily fires, less reactive management, and it gives you an additional leg up on those spinning plates, right? Next, as you kind of think through this planning and evaluation process, develop action plans with milestones and timelines, kind of going back to that planning pyramid that I talked about. Thank you. These actions will start to empower you and start to help you proactively, push your business forward. Making sure that what you do, as again, referring back to that planning process, what are your priorities for each week? What are the priorities for the people that work for you? What are the things that you want to get done? Those are important aspects of planning that are important. And then, each day, set priorities for your day. Make sure you know what you want to accomplish. If you go into the day just assuming you're going to be fighting fires all day, at the end of the day, that's all you'll have done is fought fires. So set priorities, set expectations for yourself, hold people accountable to get things done. And again, this invitation to do these pre-sessions. So this all, again, lines up with this planning pyramid and this notion of how to get things done, building on core values, purpose, targets, goals, actions, schedules, and so on. Thanks a lot, Jeremy. Hello, come on in. Okay, so now we're going to start getting into this idea of how do you know how you're doing? And this is where we start to look at these financial reports and you know what it means to be a business owner and to run your business through an understanding of how it's working from financial reporting. And I'll have to admit that, you know, financial reports aren't going to tell you everything about your business, but they're going to tell you a lot, and they're going to contribute to sort of this overall profile of where your business is. So they're going to be very important. So how do we do that? First of all, we establish systems like accounting systems to help us monitor and accomplish your plan. And I'll stop here and just ask, do you guys have accounting systems currently?
Just QuickBooks.
QuickBooks?
Yeah,
That's good.
That's what we use.
I
Okay.
just use Excel.
Okay.
spreadsheets.
So an Excel spreadsheet, that's good. So my encouragement to you is, as your organization, as your business grows, think about ways to develop automation in your accounting practices. QuickBooks is a great way to do it. You know, they're very flexible. They serve a lot of clients and they do a good job. Plus, a lot of bookkeepers know QuickBooks. And if you don't want to do the transactions yourself, bookkeepers are a good way to go. And QuickBooks provides a lot of great reports and insights that would be helpful to you. Were there any questions? Okay. So the next thing to do is build an organization to accomplish your plan. And here we're talking about an internal and an external team. If it's just you as a sole proprietor and you're just working by yourself, recognize that there are services out there that can be helpful to you. The one that comes to mind most frequently are bookkeepers. My wife is a clay artist, and she does not get financial reports. She doesn't get financial transactions. They're not of interest to her. That's not where her passion is. And a lot of times I find that with business owners, they feel responsible for doing things with, you know, financial reports and financial transactions, but that's not where their heart's at. And it's also not what they're good at. And it also takes away from where they do have a passion. So think about where and how you might be able to get someone to help you in some of these transactional things like bookkeeping. Do your periodic review for results. So we're going to talk about metrics. We're going to talk about financial statements, making sure that as you run your business, you understand how things are going. Don't leave that for somebody else. If you've got a bookkeeper, your bookkeeper is going to do a good job, I hope, keeping the transactions straight, working with a chart of accounts, making sure that, you know, transactions are being done properly. But don't let your bookkeeper be the one that reviews your financial reports. That bookkeeper doesn't have the vested interest that you do. Make sure you give yourself time to review these financial reports, review where your company is, where your business is, so that you can do something about and make changes where they're necessary. Adjust your plan for current facts and circumstances. Create to-do lists and work them, right? Don't, like I've done in my past, I've created to-do lists and I felt like, okay, I've got the to-do list done. That's it. That's less than half of the task. You then got to work it. You got to get it done. So all of this really reflects something that's called management or financial management, right? This is proactively managing your business so that you can reduce daily fires. You can ensure that your business is going in the direction you want it to, or you can ensure that you're making changes to your business that are necessary to keep it viable, to keep it sustainable, to keep it in place, to keep it producing income for you. So I have a short story. In my house, we hired a contractor to come in and put a sink in a workshop. And the contractor sent out a salesperson who was great. And they did a really phenomenal job of asking us questions, trying to figure out what we were looking for, gave us ideas about how we might do it differently. It was great. And they gave us a price. They quoted a really reasonable price. And so maybe a week later, the installer comes in. And the installer sits down and reviews a statement of work that we've put together and the pricing. And he says, well, we've got some problems. We can't do this for this price. And so we kind of went round and around and I asked, okay, so what's the impact going to be? And he said, well, I've got to do this differently and this isn't going to fit. And he said, the price is going to double. And I knew this was really important to my wife. And so in a moment of weakness, I said, okay, all right, if it's going to double, it's a reasonable price, even at double, let's go for it.
Is the installer from the same company as the sales guy?
Installers from the same company. So the installer gets started and he comes back a little bit later and he says, well, the price is going to go up again because I didn't realize you had this problem with your drain. At that point, as a customer, I'm feeling like I'm being taken advantage of, right? This guy is just going to keep coming back and adding cost. And pretty soon, I could have gone to somebody else for that price. So I told him to pack his stuff up and to leave. I didn't want the work done. So interestingly, he got all the stuff, his tools, and out he went. It was kind of unceremonious. Nothing happened. And I really expected the owner of the company to call me. I expected the owner to say, I'm sorry, we're going to do something different, or I'm going to give you a discount, or I apologize for, whatever. Let me try to make it up to you or make it better. Crickets. There was no response from the business owner. And to me, that's a failure of management and leadership to take care of a customer. It's a failure of repeatable processes where somebody's supposed to know how to get something done and they don't do it. Maybe it was intentional. Maybe that was their business model, but I want to give them credit and say that wasn't what they intended to do. But the whole notion here is that business owner at some point is going to look at a financial statement and he's going to realize that he put a ton of time into sending that guy to my house, to giving me a quote, to organizing the purchasing of equipment that needed to be done for the project, and he lost money on that deal. And if he's not in a place where he understands that and sees that through his financial reports, his business is doomed. And it's doomed not just because it was not a profitable project, but it's also doomed just because he's doing business in a poor way. So, for what it's worth. So let's take a look at some things to think about as you get into these financial statement reviews. I want to encourage you to focus on areas that have the greatest impact on your business. There are some things that just aren't going to make a difference. There are other things that are going to have critical impacts to you. It's important to you that you know which ones and where to focus. Ideally, what you want to be able to do is when you're reviewing financial statements, you want to review the financial statements on your computer, particularly if you're using an automated systems like QuickBooks, and you want to have the report that you're reviewing printed out so that you can make notes on it as you go along. So I know this sounds kind of complicated, but effectively what you're going to do is you're going to look at your automated report on your laptop or your PC, and you're going to have a printed version of it that you can make notes on. This is going to allow you to drill down deeper as you get into the meat of your financial reports. Focus on significant changes. So this is something that I think is really important, and I see entrepreneurs do, and it doesn't help them a great deal. They'll review a P&L, for example, but it's just a P&L for a single period, right? They're just looking at the P&L for last month. And what you want to be able to do is you want to be able to look at the P&L and compare it to prior periods, prior years, prior months, whatever the case might be, so that you have a good sense of how you're doing from a progress point of view. Are you progressing? Are you moving forward? Are your sales increasing? Are they decreasing? Are your costs changing? How are they changing? That comparison will give you an opportunity to see that. Don't look at a single financial statement or a single period financial statement again. It's just not going to help you. Make sure that you can see comparisons. In QuickBooks, your bookkeeper, your accountant should be able to develop those for you. We're going to talk about income statements, balance sheets, and cash flow statements. And we will also talk about some other financial reports that will be helpful to you that are associated with these three primary reports. From this review, what I'm encouraging you to do is identify questions from changes that you want to know more about. And what that requires of you is to understand at what's the threshold of change that you want to evaluate. If something changes 1% from the prior period, it's probably not worth spending a ton of time on. But if it's changing 20 or 30%, you probably want to know why the change? What's happening here? What's different? This also applies to things like your bank account. If you've got a bank reconciliation and you see dollars going out, that's probably not a big deal. But if you see tens of thousands of dollars going out, you want to know what that's all about. What's driving that? So get a sense in your mind as you review these statements. Where's your threshold? What amount of money or transactional value do you want to evaluate? Identify possible actions, things that you're going to do to fix problems. But as I've mentioned earlier, complete your review before taking action. And this is important. If you're looking at an income statement and you see a problem, don't stop and then go fix the problem on the income statement. Complete your review of the balance sheet, complete your review of the cash flow statement, and then take action. It's important to think about it in those terms. And last but not least, take notes. Jeremy, I know you're kind of a prolific note taker. That's great. Those are the kinds of things that will allow you to kind of go back from the past and see, what did I think this was, or how did this happen, or how did I change this or fix it? So taking notes and recording those notes somewhere are really helpful habits to develop. So this last note here of developing new habits, what we're talking about as we start to get into the financial statement review is developing habits that have you reviewing these reports, these statements on a regular basis. And, you know, in my own business experience, what's happened to me in the past has been that I'll look at, you know, these reports a couple of months in a row, and then I'll grow tired of it. I won't keep it going. I'll leave it to my CFO or to somebody else to do. And invariably, it comes back to biting me. So my encouragement to you is review them, make a habit out of reviewing them. If you got to do it with a glass of wine on the table, that's okay too. But give yourself the opportunity and the time to do them, to review them, to ask questions about them, and to know what they mean, what they're telling you about your business. They'll pay, that practice will pay dividends.
Hey, Mike, is there so I always hear people ask, you know, for P&Ls, and it seems to be one thing that
Mhm.
a lot of people always ask, you know, what's on your P&L? How's your P&L look? Is there a reason why that's not a part of the statements up there?
Sure. So income statement is the same as
Oh,
P&L.
Okay,
Yeah.
all right,
Yep.
gotcha.
So income statement and profit and loss statement are the same thing. Yeah. Yep. Okay. One last point before we get into the documents themselves. And bear with me. It's something that's important for you to keep track of and keep in mind is there's a difference between an accrual basis and a cash basis of statements. And if you're working with a bookkeeper or an accountant, they're going to understand that. But as the business owner, you're going to want to know as well, am I looking at a cash basis statement or am I looking at an accrual basis statement? And there are a couple of good ways to do it. In cash basis, what you're talking about is sales are recorded when the cash is received, right? Expenses and products purchased are recorded when cash is paid out. So it's the exchange of cash effectively that creates entries in your accounting system. And that's good if you're simple, if it's a small business, you know, there's nothing wrong with doing business on a cash basis. Accrual basis is what happens when, instead of based upon when cash goes in or out, what you're doing is you're looking at different transactions like sales or revenue transactions. Sales are recorded when earned, regardless of when the cash is received. So this might be a situation where you're working on a project, you deliver to a customer, but you've got 30-day terms. So in the cash basis, you'd wait till you got paid. And that doesn't make sense because you've got all this inventory that's changed hands, you've got this labor that's gone into it. So that's why an accrual basis is typically where larger companies have their financial statements. They do it on an accrual basis. What that requires is that you have an accounts receivable. So think about it in terms of I sell my product, I give my client terms, but I have to keep track of where all my invoices have gone that haven't been paid. And that's what accounts receivable does. This is when goods and services are delivered or provided and then collected later. This is a very common practice, but I've got to tell you, and we'll talk about this more, it's a real sand trap for business owners. If you're not managing your accounts receivable well, you are going to find yourself eating a ton of cash. Your cash is going to get sucked out of your organization quickly, primarily because if you're giving terms to your clients, what you're basically doing is lending them your money. And we'll see an example of that a little bit later on. Expenses and products that are purchased are recorded when incurred or received, regardless of when they're paid. So the same thing applies here. If you're buying products or services from a partner or from a vendor, when you get them, you record that transaction as opposed to when you pay for them. And what that means is you have an accounts payable system, much like accounts receivable, where you're keeping track of your receivables. Accounts payable is keeping track of who you owe money to. What the accrual basis does is it enables you to match up what you've earned with the costs that you've incurred to show you if you're making a profit or not. And that's really helpful because when you have this ability to see, for example, which of my product lines is doing better, or which of my, and we'll see in a few minutes, which of my product lines is doing better, it gives you insights into, should I put more attention in this business line or a different business line? So it gives you lots of insights. Okay. So we're going to jump to this one. And this is our income statement or profit and loss statement. And my apologies, because if you're not fairly close to the screen, that's going to be kind of hard to see. If you want to shift around or get closer, we're not going to go over the numbers in detail, so it's not going to matter that much. I'm really going to show you more about the format of the statement, but in your handouts, you'll have some examples of what we're looking at. Only this one. I'll pass along to you the presentations after the workshop. Okay, so first of all, as you asked the question, Jeremy, income statements and profit and loss statements are the same thing. They typically cover a period of time. So you might be looking at sales for a month or sales for a quarter or sales year to date. In this example, what we've got is we've got the line items on the left, and we've got the current year or current figures, current period figures, and the column to the right of that. So you can see, the current period is listed on the far left. Then we have a percentage of revenue. Percentage of revenue is really helpful because what that does is it gives you a sense of how much of your sales, for example, were the total percent of revenue. So if you look up here, you can see that the reoccurring floral services had $49,815 of sales during the period, and that was 38% of revenue. That's good to know. That tells you this is my biggest product line, or this is my biggest area that I'm doing business in. Next to that, right, the prior period. So this is kind of comparing how I did last period versus this period. It also gives you the percent of revenue. It gives you the dollar change, so the absolute change in dollars, and it gives you the percent of change so that you can see where the biggest percentage changes are. And again, just looking at sales here, you can see I've had a big change in my wedding floral services. They've gone up 146%. That's great. What did I do to make that happen? Is somebody leading that? What's different? Am I selling that, differently? It starts to answer, or it starts to give you questions to ask to allow you to see that. Just below that sorry. So in this top version where it says sales, or top section where it says sales, this is where your money is coming in. Now, in other reports, you may see this listed as revenue. So oftentimes sales and revenue are considered the same thing. So if you're looking at a financial income statement and on the top of it, it says revenue instead of sales, it means the same thing. So then you can see, again, on the left-hand column, right, you've got in-store sales, you've got delivery sales, you've got reoccurring floral sales, wedding and floral sales, and then trade shows and festivals. At the bottom of that, you've got a total sales. And this is really helpful. You want to be able to know how the organization is doing overall, as well as what part of the sales process is doing best. What has seen the most improvement over prior periods. The next section we're going to talk about is cost of goods sold. So these are effectively costs that are directly related to your sales. So this is going to be, labor associated with making the sales available. It's going to be your cost of packaging, cost of inventory, those kinds of things are all going to be considered there. They get aligned in a very similar way so that at the bottom of that list, you've got a total cost of goods sold. And in this case, it's for this period, it's $62,173. So the way these work is effectively you take your sales minus your cost of goods sold, and that gives you your gross profit. This is also typically known as gross margin. So again, these are sales or revenue, and the associated costs to get them delivered are compared, and they give you gross profit or gross margin. Now, there are often other costs associated with your sales activity that aren't included in cost of goods sold. And so this report is broken out to look at another category of expenses, which are operating expenses. So operating expenses are generally selling expenses, general administrative expenses, and fixed expenses that don't tend to change that much when you're selling your product. If I sell a dozen of a widget and I produce them all in a factory, I've got to pay for that factory. If I sell 10 dozen of those widgets, I still have the same factory. So those fixed costs are important to recognize, and they typically fall under this operating expense category here. So you can see you've got labor, you've got fixed expenses, insurance, accounting fees, those kinds of things. And at the bottom, you've got a total operating expense line item. So in this report, you can see $56,183 were basically spent on total operating expenses. So then what happens is you take your sales, your cost of goods sold, and your operating expenses, and you compare them to your sales number, and that gives you your net operating income. So now you're starting to take into account the revenue or sales I've had, what my cost of goods sold is, what my operating expenses are, and looking at your net operating income. Now, oftentimes on a P&L or an income statement, there are other expenses that you might have that aren't included in those first two expense categories. And those oftentimes are categorized or titled other expenses. So other expenses here might include interest expense, they might include amortization, they might include depreciation. If you've had startup fees or startup costs, they might be incurred here. Franchise fees might show up here. Patents, the cost of patents may wind up being included in these other expenses. But ultimately, what you're looking at is anything that doesn't fit into cost of goods sold or gross profit operating expenses. What this does, when you include the other expenses, basically you get taxes before taxes for owners. So you've got your net income, and then this is the number that your taxes are going to be based upon. Does that make sense? One of the things that's important to recognize here is that this basically shows you profitability. This shows you a comparison of your sales or revenue versus the costs to deliver them. That's what this shows you. You can have a profit every month and run out of cash. So just because this report's looking good and you're feeling good about yourself because the report's positive doesn't mean your business is healthy. To know that, you've got to look at the other reports. So the next report we want to talk about is the balance sheet. So the balance sheet is kind of different from the P&L because the balance sheet is looking at assets and liabilities and owner equity. So it's looking at a different set of numbers, still numbers, but different set of numbers. The balance sheet is typically divided or established, I should say, based upon an as of date. So your balance sheet is going to be as of December 31st or as of, the last day of the month or whatever the case may be. It's a snapshot in time. It's not looking at, like the income statement does, a period of time. Much like the income statement, I'm encouraging you to look at it from the point of view of comparison. So current year, prior year, the dollar change from one year to the next or one period to the next, and then the percent of change. And this is where it becomes really helpful to see, okay, my assets have changed, my liabilities have changed. Where are the biggest changes? What do I need to do about those? In a balance sheet, assets equal liabilities plus equity. So if you look at the bottom of the screen, you can see in current period or current year, their total assets of $398,078. Well, the combination of liabilities and owner equity is the exact same number. That's because for every transaction that occurs in your accounting system, you've got a balance, you've got a debit and a credit that balance one another. So you'll know if your report isn't working correctly, you'll know that you've got, it's not balancing out. You'll know that there's a problem. Something's happening. Now, that doesn't mean everything else in your report is absolutely correct, but it will tell you if I'm looking at a balance sheet and those numbers aren't matching, there's a problem somewhere. Okay. So this is divided, and we'll start on the asset side. This is divided between current assets and long-term assets. So current assets are convertible into cash within 12 months. So this is going to include cash. It's going to include your accounts receivable. You shouldn't have any receivables that go longer than a year. It's going to include inventory. If you have inventory that's older than a year, that's probably an issue as well. So current assets tend to be things that convert to cash within a year. Current assets are also sometimes called working capital. They are constantly churning. So when you look at this report, month one and look at it again month three, if you don't see differences, then your accounting system is not working for you. So you should be seeing these numbers change all the time. The next section of the balance sheet is known as long-term assets. And these are basically property and equipment that have a life greater than 1 year. These are going to be fixed assets, so they're going to be things like office equipment, furniture, vehicles, that kind of thing that are assets for you, but they're not convertible to cash quickly. Does that make sense? The difference between the two? For example, if you go to a bank and you tell the bank, I want to borrow money, what the bank is going to do is they're going to look at your current assets and your current liabilities. And if your current assets are less than your current liabilities, you've probably got a problem. You're probably not going to get a loan from the bank. If you've got more liabilities than you've got assets, the bank is going to look at that and say, that's probably not a good deal. That's probably not something I want to get involved in. So that working capital is an important ratio and an important thing for a banker to look at and an important thing for you to know about. So continuing on with fixed assets. These are going to be things that you generally have as part of the cost of running your business. Next is going to be other assets. And so these are going to be intangible. They're going to be things like patents, goodwill, non-competes, franchise licenses, and those kinds of things. And that's where the value of these is going to show up. You might look at this and say, other assets, I've got a deposit on my balance sheet as an asset. What is that? Well, that deposit effectively may be, in this particular case, it was the deposit that was paid down to acquire the business brick and mortar facility, right? So I have that deposit and that's likely going to come back to me. So my balance sheet has to keep track of that asset somewhere, and that's where it is. Organizational costs might be things like your computer systems, your accounting systems, your inventory system, those kinds of things. So that's where all of these assets are maintained and managed. Ultimately, what you have is you have a sort of a total asset number, which is at the very bottom of the page here, and which we talked about already, that 398,078 number. On the other side of the ledger, you can think of it as our liabilities and owner equity. And again, this is organized the same way, it's current year, prior year change, those kinds of things. But on the liability side, this is money that you owe other people or other companies. This is where accounts payable shows up. Remember, we talked about accounts payable being things that you owe for inventory and for services that may have been rendered to your company. That's where that shows up. Income tax payable shows up here. Current portions of loans will show up here. So when I say current portions, that's within the 12-month horizon that we're talking about. So those are all liabilities that are going to that are current, that are going to be due in the next 12 months. Now, if you're managing and doing your own books and you've got loans outstanding and you don't have your current portion of your loans broken out from the long-term portion of your loans, don't worry about it. It's not a big deal. In this particular case, we were able to do that because we had an accountant that kept track of the amortization schedules for the short-term portion of the loans. But if you can't do that, just keeping them all together under long-term liabilities is fine. So that kind of brings to mind the next section here, long-term liabilities. This is going to be where your bank loans are that are longer than 12 months, right? This is going to be maybe personal loans that somebody gave you, vehicle loans that are paid over a period of years. That's where those liabilities show up for the current year. So we've talked about assets. We've talked about liabilities. The last section here is owner's equity. And owner's equity is really kind of the description of what the owners have put into the company or what the company has generated itself that is on the balance sheet that reflects effectively their ownership of the company. So here you can see on the list, owner's equity. We've got Sarah Brown, who's got, owner's equity. We've got Dave and Sally Brown, who have owner's equity. This is the money that they've put into the organization. They've put into the company itself. Right? So if, as a founder of the organization, you put in $10,000, right? That would be owner's equity that would show up in this section on the balance sheet. If you came along a year later and put another $10,000 in, then that number would go from 10,000 to 20,000. That's where your owner equity would be reflected. The negative numbers that you're looking at are where distributions have happened. So what are distributions when it comes to owner's equity? Distributions are things like an investor has given the company money and I've agreed to pay them back a certain distribution. Or an owner has put money in and I've agreed to give them a distribution to pay taxes. That's often the way that these things work. A lot of times companies will use owner equity to pay owners tax liability. That's a common practice. So the other things might be draws, they might be dividends that are paid. So all of that is taken into account to sort of quantify what owner equity is. And then there's a section in here called retained earnings. So retained earnings are effectively income that the company has created. So profit that the company has created that they've invested back in the organization. So that retained earnings kind of reflects, I made a profit last year of $27,000 and I took that money and I put it back into the business. I bought more equipment or I hired a sales guy or whatever. So those retained earnings are also identified here on the balance sheet. And then last but not least, current year net profit or loss. So this is where that number shows up. And then ultimately what you have then is you've got assets on the left-hand side, owner equity and liabilities on the right-hand side, and those numbers match. And again, the reason they match is because every time I bring in value to the company, I have an offsetting transaction that debits an account. Every time I sell something, there's a credit and there's an offsetting debit that occurs in my chart of accounts. That's what makes a balance sheet balance. Questions about that? Okay.
So I have a question about
Yes.
liabilities. So when you get a loan, let's say for the term is going to be 3 years,
Mhm.
paid out. The loan is going to be for $10,000.
Okay.
Should we put the $10,000 for this specific year because I know this is yearly, or should we just put like the full amount of the loan? Does that make sense?
It does, yeah. So the best practice is the amount of that $10,000 that you owe in the current year, you want to have it in your current liability. Not necessarily the full amount, only the amount that's due in the current year. If it's 3 years, you've got 3 years to pay it, the first year will show up there. The other 2 years that you will get to later show up in long-term liability. If you don't have the capacity to do that, if you're doing your own books in Excel, don't worry about it. It's not gonna be a huge problem, but it's helpful when you break it out and you understand that it's different. You've got a different short-term liability versus a long-term.
So long-term liability is basically 12 months.
Yeah, more than 12 months. Yes. Yeah. Okay. The next thing we're going to look at, we just talked about that money in and money out. Did you have a question? Okay. Next thing we're going to talk about is a cash flow statement. And to be honest, cash flow statements confuse me every time I sit down and look at them. But they're a really handy and useful report. So I would encourage you, particularly if you've got somebody that's doing your books for you, you can look at them and look at the statement and understand. So much like a P&L or an income statement, the cash flow statement covers a period of time. So this might be, the beginning of the month to the end of the month, the beginning of a quarter to the end of a quarter, the beginning of a year to the end of the year. It's a period of time. And you start the very top line item. Well, let me take a step back. Much like we did the other two reports, you want a comparison capability. So you're looking at current year, prior year change. The top line number that you're looking at is your cash balance where you start. So beginning cash balance is that top number there. And the way this works is positive numbers are money that comes in, and negative numbers, money that goes out. So if you see a negative number, then money is reducing. And if you see positive number, then money is increasing. And what you have is you have the beginning cash plus inflows and outflows equal ending cash. So all of the math in between the top line and the bottom line sum up. And that's how you get to that bottom line number. But you start with beginning cash. Then what you start to look at is cash that's coming in and going out from the income statement. So this is now starting to look at things like your net income from the prior period. You're looking at non-cash amortization and non-cash depreciation. Don't worry too much about those terms. They're effectively just keeping track of where depreciation and amortization is happening. They're not necessarily dollar values that you're losing or that's moving. But in order for your income statement and your cash flow statement to kind of balance, you have to keep those two things in mind. Those the non-cash amortization and non-cash depreciation. Ultimately, what you get is you get an adjusted net income. So our net income increased and impacted cash by $9,000. So then this next section is inflows and outflows from the balance sheet. So here we're talking about changes in assets and changes in liabilities. And you can see here, we've got a change in home contract receivables. So that's a minus. It's a reduction of 210,000. Same thing in commercial contract receivables. That's a reduction of 899,000. So that's kind of how this is used is, where the value has changed. Has it gone up or has it gone down? And what you can see in those two cases, it's gone down. In inventory, it's gone up. Accounts payable has gone down. Income tax payable is up. And that's kind of a way to kind of think through this. Ultimately, what that boils out to is, your total use of cash from operating activities is, let's see, $7,401, right? So then you drop down even further and you start looking at cash from debt. So bank loans, loans from investors, those kinds of things, and they have a subtotal. And then ultimately cash from owner equity. So distributions that have taken cash out of the organization, dividends, withdrawals for taxes, those kinds of things have taken cash out. Ultimately, what you've done is you've reduced your cash in that area by $21,000. So you've had an increase of $9,000 from operating activity, and you've had a reduction in other areas, which gives you a net change of $16,187, the beginning of the year, the beginning of the period to the end of the period. So you've gone from $270,000 that you started with, and you're now at $254,000 and change. That kind of makes sense. You can look at it from a prior year perspective. So comparing how did I do last year from this year, and you can get some sense of, okay, well, my adjusted net income was higher last year than it was this year. I went from $10,094 to $9,079. Where did that change occur? And you can see that it occurred in net income. So you can go back to your income statement and look and see, well, what's the difference there? And find out why is my current year number different than my other year? That's why these reports are important to have and review simultaneously, or at least in series. If you look at one and take action and don't look at the rest of them, you could miss something that would be important to you. So we've talked about that and your ending cash balance. Okay. So now what we're going to start to do is we're going to start to look at some of the reports that are helpful. These are ancillary or supporting reports that you can look at that accompany the income statement, the balance sheet, and the cash flow statement. And again, we talked a little bit about, where do you want to focus your attention? Well, is there a meaningful change in the number somewhere? In this particular case, you're looking at cash went from 148 to 254. Why the change? What happened? Is it temporary? So there's a story behind it somewhere, and you need to go figure out what that story is all about. And does it make sense for the business? So being able to have that comparison is really important. Is it tied up in other categories on your balance sheet? In this particular case, we know what happened was there was a big loan payment that occurred at the end of the last period. So or the beginning of this current period. So what wound up happening is they paid down their debt, and that's why it went from 148 to 254. And actually, I've got that backwards, don't I? Anyway, the point is that you can look at these numbers and see that they're different, and then go figure out what the changes are. What actions need to take, or do you need to take? And then ultimately, this question of, where do I focus my attention? I've got a P&L, I've got a balance sheet. If I don't have cash, my company doesn't run. So knowing for sure that cash is king, that you've got to have cash to run your business is a key component. What we'll do is we'll take a look at some of the places where cash gets lost. One of them is in what's called accounts receivable. We talked a little bit about AR, and it represents money that's owed to your business by your customers who bought from you on credit. So knowing what your accounts receivable is at any given time is important, because ultimately, if your accounts receivable is growing, and it's growing because your accounts receivable, your customers aren't paying you on time, that's a bad reason. If it's increasing because you've got lots of sales, that's a good reason. So it's acceptable to have a high accounts receivable figure or higher than a previous period if your sales are going up. But if your clients aren't paying you on time, that's a bad reason, and you don't want that to happen to you. So this is a typical accounts receivable aging report. If you're running a business and you have, you're selling on an accrual basis, and you've got, clients that owe you money, I would highly recommend that you have a report like this and you look at it regularly, right? So your clients are listed on the left-hand side, left column, and then you've got these categories of 0 to 30 days, 30 to 60 days, 61 to 90, 91 to 120, and over 120 days. If the terms on your contracts, when you're selling to clients, your sales orders, your invoices are 30 days, then all of your accounts receivable ought to be within that 30-day period. If you've got people that aren't paying you within 30 days, as in Hotel A and a couple of others, that's a problem because they're holding your money. Now, it might be for a good reason. Had I gone through with the story I told you and paid this plumber to put in the sink and it didn't work, I wouldn't have paid him. So that might be a reason why people aren't paying you on time, is because they're not satisfied with your services or your products. But if you've got things greater than 30 days due, you need to ask questions about why that's happening. Why is that taking place? What can we do as a company to fix that? It's critical that somebody stays focused on receivables management. One of the things that I can tell you is I worked on a consulting company. And the consulting company had, they were selling primarily their services to government agencies. And a lot of government agencies wouldn't accept 30-day terms. The procurement rules said, it had to be a longer period of time. So we changed our accounting practices and our receivable expectations based upon that. But over time, these agencies got really, really good at knowing when they could stop paying us and when they had to pay us before we reported them to a credit agency. And so they would pay us 120 days out, 160 days out. And it was really costing the company a lot of money. So ultimately what the president of the company did, he was one of the founders, he required all of his senior managers to basically take one of these clients and call them, talk to them, and be accountable for the payment from that client. And the accounts receivable went from about $1.3 million down to about $250,000 in about 60 days. It was remarkable how much it changed just by having somebody work it and focus on it. So my encouragement to you is, even if you're a sole person working by yourself in the business, make sure you know who owes you money and when it's due.
That is actually one of the main reasons as to why businesses have poor cash management.
That's right. That's right.
That happens a lot in construction. We have employees that have participated in events.
Mhm.
They go out.
Yep.
Go out of business.
They go out of business. That's right. So these are just notes or things I've already covered. So a couple of things to keep in mind. If you're doing receivables management and you're a consulting company or a services company or construction business, make sure that as you're selling your services or what you're providing to your clients, that you're asking for money up front to help offset the cost of things like materials or labor that you have to invest in the project. Make sure that you're doing progress billings or draws against a project so that you're able to get paid during the course of the delivery of the project. To Andy's point earlier, if you don't have those progress payments, a lot of times what happens is you don't have the cash to pay your employees. So you run into that rock and a hard spot place where you're asking employees to work without pay so the project gets delivered. That's a tough spot to be in. Are you requesting fast turnaround for progress billings and draws? Are you maximizing your leverage to collect timely, making sure that when you have met a milestone or completed a project, are you asking for payment at the time that you have your walkthrough or your final acceptance review? Don't let that slip for a day or a week or a month. Ask for the cash at the time that you go through that process. Many of you probably know this and have experienced this, but pest control and lawn services are something that I get to compare at my house. So I have a pest control company and they call me when they're on their way. They tell me that they're going to do a service. They get there, they introduce themselves, they tell me they're going to start. They do their pest control thing. They come back to the front door and they say, now I'm going to bill your credit card, right? And unless I've got a huge problem, I say, okay. And I know to expect that $100 or whatever it is going to hit my credit card. And away they go. The guy's basically paid for himself by doing that service. He gets his money right off the bat. I've got a lawn company that mows grass every once in a while. And they bill me every month. He comes 3 times a month, mows my grass, and at the end of the month, he bills me. Who do you think has a better receivables? Who do you think is getting their money faster? Yeah, exactly. So it's important to pay attention to how you bill your clients. And if you can bill them with a credit card, or you can bill them in some automated fashion after you deliver your products or services, I would highly encourage you to do that. Now, a lot of that may depend on your industry. So if your industry doesn't support it, then that might be a problem. But my encouragement to you is try it. So this is an example of accounts receivable turnover. And the example is, the company has an annual sales of $600,000 and an average accounts receivable amount of $50,000 per month. So $50,000 per month is the average of my accounts receivable balances, and I do $600,000 a year in sales. So what that means is that effectively I'm turning my accounts receivable 12 times a year, right? 12 into 600 or 5,000 into 600,000 12 times. So that says, I've got 30 days of sales and receivables. So that's pretty good performance. If the same company that has the same annual sales has a receivables balance of 100,000, so not 50,000, but 100,000, right? That means that they're turning their sales every 60 days or turning their receivables every 60 days. And that means they have an extra $50,000 tied up in receivables from the competitor in example 1, or in the first example. You see the difference? Both companies have 600,000 in sales. One manages it so that they have 30 days of receivables or $50,000 per month in receivables. The second company doesn't do quite as good a job, and they have $100,000 in receivables, which is 60 days, which means they have $50,000 more tied up. That's $50,000 in cash that could be used for something in their business. So one of the things that's important to know is there should be industry benchmarks for your type of business that you can look at and compare with other companies like yours. And you can find these through the Department of Commerce, the Department of Labor. Find out what the NSF code is from for your business, and I look for what the industry averages are. They're posted and they're available for you, so you should be able to find them. These are also key ratios for bankers. So if you're going to go to a banker and borrow money, they're going to want to look at how well you manage receivables. That's going to be a big deal for them. And to Andy's point earlier, receivables can eat up your cash flow if not managed with strong discipline. So inventory is the same way. I know we're kind of getting close, and I don't want to go past 7:30. So we've only got a few more slides here. Inventory is another place where you can eat up a lot of cash if you're not turning your inventory. If your inventory is going up, which is the case here from prior year, then that could be a good thing because sales are increasing. But if your average age of inventory has increased, so you've got more inventory and it's older, that's a bad reason, much like accounts receivable. So some other things to think about with regards to inventory, if you have lots of inventory, you've probably, and that inventory is over a year old, you probably are in a place where you're going to have to either get rid of that inventory or reserve for it. Because if you can't use it within a year, it's probably obsolete. It's probably not good for you. Which means the price of all of your inventory effectively has gone up. If your inventory is going up, your inventory value is going up, these are some of the possible reasons why. Maybe you have a theft problem. Maybe you have a poor inventory management process. Maybe you're not turning your inventory and getting rid of old inventory fast enough. There's a process called FIFO, which is first in, first out. Are you following a FIFO process? So inventory can be a big drain on cash, and if you're not comfortable and if you're not careful, it can suck up a lot of cash. So one of the things about inventory that I think is so interesting is that inventory has obviously an impact on how you deliver your goods and services, but you can also have a big impact on how you buy inventory. So a lot of things that come into play here are, what your lead times are, how long does it take your vendors to deliver your inventory to you, and consequently, how often do you buy? What's your frequency of buying? And because your inventory and your sales tend to adjust a lot, you want to be able to make sure that you're continually evaluating your purchasing decisions and your purchasing policies and practices so that you're not buying too slowly based upon what your business is consuming. So it's important to be able to recognize how to purchase based upon the volume and the throughput of your inventory. If cash is tight, open to buy process is important. This is where you only buy inventory when you have an order. This, much like the other example that I showed you, looks at two scenarios where you're buying $30,000 of inventory to cover a 3-month supply. And each month you consume a $10,000 worth of inventory. So in the first scenario, what you've got is you're buying $30,000 worth of inventory at one time, and you're working off that inventory over 3 months. And you can see here the cumulative cash deficit in month 1 is $14,600. In month 2 is $800. In month 3 is a positive $16,200. But if you were to buy your inventory each month, so 10,000, 10,000, 10,000, instead of 30,000 in 1 month, you can see that you would have a much better cash flow each month instead of at just the last month. So inventory purchase practices are really important as another way to conserve cash. Inventory turnover is much like AR. You want to be able to turn your inventory over as often as you can. If you're not turning inventory over, what you're doing is you're paying for obsolete inventory. And this is an example, much like the last one. If you've got an average balance of $100,000, you're doing $100,000 a year in cost of goods sold, you're turning your inventory 1 time a year. However, if you turn your inventory 4 times a year, that means your average inventory balance is $25,000, and it gives you a much better cash flow. Understand what your benchmarks are for your industry, but also recognize that you need to be turning your inventory quickly. I'm going to stop it here. We can pick this up, accounts payable, next week if you join us. But I did want to stop, give everybody a chance to ask any final questions before we end, and give everybody a chance to get home on this rainy evening. Any thoughts or questions?
Is there any advantage of running like the P&Ls and balance sheets on accrual versus cash basis? Like my CPA always asks for stuff on a cash basis, but I just realized that I ran these reports on accrual basis.
Sure.
So, that caused some confusion. I just wanted to know kind of your thoughts on that.
I think best practice, particularly when you have clients that are paying you on account or vendors that you're paying on account. I think you want to use the accrual basis. Yeah. It's not that difficult, from what I understand, Jeremy, to switch QuickBooks from reporting accrual versus cash, but I think you probably want to manage the business on an accrual basis. Mhm. Other questions? Okay. Well, next week we're going to finish up with accounts payable. We're also going to talk about how to look at some of these reports and figure out where problems are and what to do about the problems. And let's see. Yeah, so we'll also, we'll talk about pricing, we'll talk about break-even analysis, and then we'll talk about, common accounting problems for statements. So if you want to join us for that, I would love to have you. Hopefully it won't be raining. Okay, that's it. If there are no other questions.
Thank you.
Great.
Thank you so much.
Yeah, you're so welcome.
Really
Thank you very
good
much.
information. Yeah.
Thank you so much. Appreciate it.
Yeah, thank you.
You want to send this presentation forward, right?
Yeah.
I will send you this to you.
Okay, great, thank you.
Maybe you just said that, so the PowerPoint,
Yeah.
you'll send that out.
I'll send it out.